And I mentioned this at the beginning of every single webinar. You guys watch it again. Maybe not necessarily this specific one, but watch one on, say, the long call option strategy, because I may say some different things in some of the other ones that I forget about, and or mention something in this one that I didn't mention in the one before. So, and how we're going to do this is we're going to look through, we're going to come up with our strategy for, or our bias, I should say, our bias first. Like when we're looking at charts and all these other things, or watching TV, and we get some kind of assumption where we believe the market is going to go in a certain direction, we've already come up with that, okay? So we kind of have an idea of the underlying, but we are bullish in this one. So when we're going through the rules, keep that in mind. We've got our assumption, we're bullish. Now we have to figure out, going through all these different rules and things of that nature, to find out the proper strategy for it. Now I kind of cheat and I'm giving it away for you guys, but that's the kind of thought process I want you guys going through. Yes, in the back of your mind, you know we're going to end up with a long call, okay? But think about it this way. Before we came into this webinar, we were just getting ready to set up our trading day and or for tomorrow, looking for something, and we find a bullish bias in something, okay? So think of it that way. How's your tan working in Arizona? Not very good from inside my office for the better part of the day. All right, let me get a couple things out of the way real quick. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I started trading in college and moved to Chicago, and in that time I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all those products in all market, in basically every market condition, I would have to say. Really quick, any opinions, news, research, or analysis, or other information contained in this webinar is for general commentary, you guys. I am here to teach you how to trade options around things. I'm not here to say you need to go out and do this. And the reason why I don't believe in that type of guidance is because that may be counterintuitive to your portfolio and your risk parameters, okay? So we have to figure out, is this appropriate for us? I can't tell you that it is because I don't know how much risk tolerance you have, all right? And bottom line is, do your own homework. Past performance of any trading system or methodology is not necessarily indicative of future results. All right, you guys can follow me on on Twitter at Wolfman's Blog, or our parent company at ProTraderStrat. For any kind of market wisdom and or snark from me. All right, I want to go over a couple of things real quick because we're going to be talking about these throughout. Delta. Delta affects an option premium in relation to the underlying's first dollar move. Okay, so that's pretty simple, you guys. When we are pulling up the platform here, this delta, if we look over here at delta over on this side, that means if XYZ or Chipotle goes from $702.51 to $703.51, $1 higher, this strike, the 705 option strike, will increase by 50 cents. That's the delta, right? So when it moves, the underlying moves up by $1, these premiums would increase by 50 cents. That's the delta. It tells us a lot of things, but that is the idea. If the underlying moves up by $1, your option price will move up by the correlated delta, okay? And then gamma is the rate of change to delta. So gamma really just tells us what happens to delta on that second dollar move, right? So we went from 102 to 103.51. Now we're talking 104.51. So that same strike here, this 705 strike, now we're trading 704.51. Well, the first dollar increase, or the first dollar increased by 50 cents. The second dollar increases by the gamma plus the delta. So if we looked at right in the middle of the road here, let's just say it was $17, okay? $17 was our price right in the middle. The first dollar went to $17.50. The second dollar would increase by the 50 cents plus the gamma, so another 51 cents. So after the second dollar move, we should be expecting it to be around $18 or $18.01. Okay. So gamma tells us what the second dollar does. Okay. So it's the rate of change to delta. So think of it that way. Delta, we know the first dollar move. Gamma is that second dollar move, and gamma gets added into that delta for that second dollar move. Okay. I would change that picture where you are crying. Which one? Oh, is that the one? Is this the one you're talking about down here? Yeah, that's a great haircut day too, or a great hair day. That was a rough one. Anyway, and then theta is the impact of time on the premium. So we've talked about delta, how it changes by the dollar. Now we have 1 day go by. So tomorrow, these premiums should decrease by this theta. So tomorrow, all of these premiums will decrease by 42 cents, okay? Or this one will decrease by 42 cents. So will this one. This one will only decrease by 41. This one will decrease by 36. This one will decrease by 35, okay? So that's how theta is the rate or the impact on that premium. And for anything, it's a negative by the day. So every day that goes by, it decreases by that much, okay? On the calls or the puts. All right. And then finally, we have the Vega. And Vega is the measure of change in volatility, okay? So all that's saying is that when volatility, this volatility goes from 29.14 to 30.14, then these premiums increase by the Vega, which would be 69 cents. So if it increased by 1 percentage point, this would increase by 69 cents. Vice versa, these would be as well. If it increased by 1%, these would increase in price by the Vega. Vice versa, if volatility went down from 29 to 28, this would decrease by that 69 cents, right? As the market, or as this goes down, this should be negative as well. And that's the same for delta as well. I was only giving you the example on the upside, but the delta over here, if the market were to go down, think about it, we have a negative now. A negative and a positive is a negative. So it would decrease by 50 cents. Just like delta on the put side is negative, okay? So if the market went down by $1, a negative plus a negative is a positive. So these would increase by the 46 cents. Vice versa, if the market went up by $1, these premiums would decrease. Does that make sense? For all options on April 18th. That is for these options, yes, in and around the April 18th ones. But as volatility increases by that percentage point, you will see that affect the options premiums across the board. So that would be the same out here as well. Okay? Does that answer your question? Good. All right. Like I mentioned, this is the long call one. I'm letting the cat out of the bag way early. But the idea is we need to have a directional assumption. And we're very bullish, okay? We don't want to be like neutral to bullish. We want to be very bullish. And as a matter of fact, on the floor, we used to say this, you're as bullish as a matador. And meaning mad, you're crazy mad bullish on this type of trade. All right, so essentials to success, picking the right underlying. We have the underlying in mind, right? Because we've got a bullish strategy. So some of you guys that have watched several of my webinars in the past know that these might be a little bit out of order depending on, all of them are the same. The keys to success are the same, but I put them in different orders because I want you guys to go through this as a thought process, right? We need to narrow it down in a sense to the long call. Again, we already let the cat out of the bag, but this is the idea. XYZ, I have a bullish assumption in. Well, if I have a bullish assumption in XYZ, what I need to figure out is it the right underlying? Is it appropriate to trade options? And believe it or not, CMG fits this rule. But any stock over $100, you move the decimal place 3 ticks to the left, and that's how wide the bid to the offer should be during open market operations. We are doing this webinar after the close, and people's orders get canceled. So this isn't a real reflective market of what's going on, okay? It's usually much tighter than this, and it does fit the 70-cent rule from the bid to the offer, even on something as high as Chipotle being a, almost $1,000 stock. Any stock over $100, 3 ticks to the left, that's how wide it should be to the bid offer. If it's under $100, Activision, let's say, any stock under $100, our rule of thumb is it needs to be at least 10 cents wide, inside of 10 cents wide to the bid offer, like this is right here, okay? During open market operations, you guys, I can't emphasize that enough. Think about it. When you guys, at the end of the day, if you don't have it in as a GTC, it gets canceled. So it's not being shown, or you're not able to see it in these markets, okay? This is whoever's left over, all right? So that's picking the right underlying. Decimal place, 3 ticks to the left on a stock over $100, say for instance like Disney, 3 ticks to the left, 11 cents wide, and that's how wide these should be, okay? And then we need to go over and find, is it the right environment? I mean, we're narrowing this down to the long call. We haven't really decided on the long call right now. So what we're doing is XYZ. I'm going to just give an example of something that I might be bullish in. So that might fit the rules. And I'm going to go with American Airlines. American Airlines has and that tight bid ask is on the spot month, okay? Not out here. Don't go out here for that rule of thumb on picking the right underlying. You go out here, several hundred days out, and you're like, oh my God, that's way too wide. The one in the spot month is really where we're looking at it. And that's the one that's the monthly that is closest to expiration, or closest to like 35 days to expiration in a sense, okay? That's where most people are trading. So that's where that rule needs to fit. And then picking the right environment. This has to do with, we want something that has really low implied volatility percent. So we go down here, and anything below 50 for a stock meets this rule, all right, for implied volatility percent of below 50. You really want to get as low as you can, is the best case scenario, because the lower the implied volatility, the less Vega affects us negatively. Because remember, we said if volatility goes down, that can hurt us, right? So we could be directionally right. This market is moving higher and volatility is going down. In one of those examples, we saw volatility, what was it? I think it was on Chipotle. Volatility is almost stronger when it's really high, or when it has high implied volatility, or some good Vega to it. You can see that Vega could offset the delta, all right? Now, you get in closer, it's not going to be as much of a concern, but we can see the further out we go. And the reason why I'm saying this, because we are going to try go out pretty far, but you can see the further out you go, volatility is affecting those premiums a little bit more. So you need to be aware of that. And when it has really high implied volatility, like Chipotle, I don't know why I picked the other one. When it has really high implied volatility, let me close some of these. When it has really high implied volatility, did you guys get that yet? Then you can see that that's even more. So we have a super high implied volatility. We don't want volatility to go down, is what I'm saying, if we are coming up with a long call, all right, for this underlying. Now, we already picked one, that picking the right underlying. We have one in mind, and that was American Airlines, right? I came up with a bullish assumption. How did I come up with it? Well, sorry, I'm going to rewind a little bit here because I want to get this straight here. So we're going through our charts, and I just come up with American Airlines. And I'm like, okay, well, this looks a little overdone to the downside. Maybe you're saying it's found some support down here. We can get rid of these really, really old Fibonacci lines here. So let me just get rid of it. Anyway, I just want to get rid of you. Remove all drawing. All right. It's trying to get rid of the wrong thing. Anyway, so I found that, look, yes, one could say it's having lower lows, lower highs, whatever it is. Look, I'm just saying I'm coming up with a bullish assumption. It's got tweezer bottoms here. I think it's going to go up. Maybe it's making some kind of head and shoulders here. I don't know. So upside down head and shoulders. So I'm expecting it to move higher with XYZ. So first thing I would do is it the right underlying? I go over here, closest to expiration. It's under $100. Is the bid to the offer inside of 10 cents wide? Yes. Okay, well, now I know American Airlines is a tradable stock with options. I have this bullish assumption. Now I have to think, okay, well, what is volatility for this one? Well, I go over here and I can see implied volatility is 36. Keep in mind, this 36 means nothing when I say below 50 or above 50, right? Below 50, we're buying option premium. Above 50, we're selling options premium. It has nothing to do with just this number over here at 36. What that has to do with is where this is in relation to where it's been in the past, because every stock has a high and low implied volatility, all right? A utility stocks or something like Clorox, 19 is low for them and 36 is extremely high, right? Well, we're just looking at AAL, and AAL has 36 as being pretty mediocre at best for this stock, right? So don't look at this on my rule where I'm saying above 50 or below 50 for the environment. It's the percent. It's where it is in relation to the past. And there's a fraction here, and we have a sum in the numerator. We have to divide by the sum in the denominator. The sum in the numerator on top of the fraction is basically you take the current implied volatility minus the low. So 36 minus 26. 36 minus 26 gives us 10. And then you divide that by the high minus the low. 67 minus 10 is 57. So we have 10 divided by 57. So we are in the 20th percentile, right? So we can go over here also and come up with the math, 21%. But that's how they come up with this implied volatility percent, is they take where the current is, subtract the low. That sum is then divided by the high minus the low, okay? It's pretty simple. Over here I have it. I have the code that you throw in here to put it in your watch list. So, and you can see I have them. I don't care what the stocks are. I just have them listed by this because it's one of the most important metrics I look at, all right, is implied volatility percent. Because that tells us when premium for AAL is relatively cheap. Think about it. When volatility is really low, that is as cheap as you are going to find these options premiums, okay? But when volatility is extremely high, say, upwards of 75 or 100%, then you know that those premiums are at their most expensive, okay? Now, do you want to buy something when it's at its most expensive level, or do you want to sell it there? And vice versa, for the same product, do you want to buy it when it's the cheapest you've ever seen it, or when it is the most expensive you've ever seen it, right? So the idea is this is like a chart too. Volatility, when it gets really low, it has a tendency to want to migrate back to the mean or the median where it's comfortable. This is its comfort zone. And when it gets overextended to the upside, it wants to come back, okay? Think of it that way. It's overextended, we would be selling premium. When it's way low, we would be buying premium. And for AAL, we can see the premiums should be relatively cheap because of the volatility, all right? So when I'm going through these steps and I picked the right underlying, I know AAL, we can trade options around it. I've picked the right environment I found the right environment. This is really low implied volatility. I still have this bullish assumption because of the chart, right? I think, okay, I think it's going to at least come back to here, maybe up here, whatever my assumption, my bias is. I have a bullish bias is all we really need to worry about. And then picking the right duration. We want more than 45 days to expiration. You know, normally when we talk about premiums, we are looking at like this being the dividing line. Here we sell premium, here we buy premium. This is a buy premium area, this is a sell premium area. Because this is theta decay. You can see it increases the more or the closer we get to expiration. Out here, you can see we're not going to be losing as much per day on our theta decay. All options lose money. You can go out really far too. It will start to kind of slowly flatten out even more. But, you know, you're also paying a lot more for those premiums. It's not going to decay as much, but it does give you a lot more time to be right. So we want to go somewhere outside of 45 days to expiration. I kind of like it inside of this like 50, 60, 70 days right in here, okay? That's my sweet spot for just the long call. Usually with this strategy, I'm not going to be in it for that long. I'm not going to be in it for the next 70 days, okay? I only plan on being in it for a couple of weeks, but I do want to limit my theta decay, okay? I don't, even though I'm paying a lot less out here, it hurts me a lot more the closer to expiration. So buy your premium for the long call out in this area, all right? That's what we're looking for. So the duration outside of 45 days, picking the right strikes. We're going to go pretty close to the at the money options, but just slightly they're outside of it. And we're going to be looking, depending on how wildly bullish you are, you know, somewhere between 45 delta to the 35 delta. And I don't go much further than that, you guys, because your probabilities of success are not very good. All right. So, and another thing for some of you beginner traders, if you are wondering like what kind of quantity, for crying out loud, should I be using with options? Well, if you're used to trading 100 lot in a stock, then you would use one option contract here, okay? Another way to look at it is if you had, let's say $1,000 or $100,000 in your trading account, I would not like to risk more than like $2,000 on one particular trade for this long call, okay? Most I would risk on this would be probably $2,000 to be quite honest on a $100,000 account. And you could scale that up from there. $200,000 account, you know, $200,000 account, maybe you would be risking $4,000 on this particular trade. Does that make sense for everybody? All right. And knowing our exit strategy. Now, when the price doubles, that's usually when you are super bullish, okay? And that's what we're kind of looking for. That is, in my eyes, a home run. If the price doubles for you. Another way to look at it, and I'm more likely to have the price double on stocks, you know, below 50. I'm going to be pushing for that. But, you know, really high price stocks, I'm probably going to be looking closer to a 50% increase in that underlying, okay? Or if the target gets hit. And if my target price gets hit, then most likely you are going to be at that 50% increase in your underlying, premium value. Okay. So know that if we're picking a target, say in XYZ, we know it's going to go there. I'm going to look to get out at a 50% increase. So if I paid $1, I'm looking to get out at $1.50, right? I paid $2, I'm looking to get out at $3. If you're super bullish, then you could look at it. If I paid $1, I'm looking to get out at $2. Okay, I have no problem with that. You're going to have probably a higher risk tolerance than most people, though, too. Okay. When you say you risk 2% on the trade, does that mean the premium it would be 4%? Yes. So and that is for long calls. Okay, Neil. So what I'm saying, 1 to 2%. On a trade like this, that is for the long call. I would not, if I put on a trade with the long call, I would not risk more than probably 2% of my portfolio value on it. And one of the reasons for that is it's a very low probability strategy, okay? It has a a potential of making a whole lot of money, but the probabilities of that happening are very slim, all right? And I would rather cover this trade when I've beaten the probabilities than waiting for the probabilities to work themselves all the way out, okay? And I'll show you what I mean by that when we start pulling up the trading platform. So we're looking for, if you're looking for a double, you are bullish as a matador, and you're spelling matador capital M-A-D. And if you are, bullish on this and you think I'm pretty bullish, but I have a lower risk tolerance, I don't want to risk that much. I want to get in and get out of this trade because I know it's a lower probability of success, then I would go for the 50% increase in that premium. Can you go over the right strike price a bit more? Didn't follow. Now, when I'm talking about picking the right strike, what I'm talking about here is I'm looking at I might have brushed over this a little bit quick. So I'm going to go probably further out than the 50 days. I said around the 70 days, but I'd rather go further out in time and limit my theta decay. You can see theta decay is only 1 penny here, whereas inside of here, it could be closer to a nickel. Yeah, 3 cents, all right? So I'm going to want to go further out to limit that decay per day. And I want really low volatility because I don't want it to negatively affect me. If volatility goes down, I'm going to be losing money. But I don't care if volatility goes up, right? If volatility goes up, then that helps me, right? So picking the right strike, I'm looking at about a 45 to 35 delta, which is right here, 45 to 35 delta. And when I would say this is a $200,000 account, I would probably be risking, because it's $1,600, I'd probably be risking, about what is that, close to a 10 lot or something. So I'd probably do a 10 lot on this one. Okay. But if you're just getting started, then look at it a little bit smaller. So I would try and keep it somewhere around a $1,500 trade. Actually, yeah. Okay. Oops. So we want to make it down to a 1 lot just to see, and then confirm that trade. $161 is our, oops, I want to buy it. So buy that one. And it's going to be $161. So, this might be a $10,000 account, all right? And I'd be doing it as a 1 lot. 10 lot probably on a $200,000 account, right? But the 45 to 35 days to expiration. Now, delta also tells us something else, you guys. It tells us the probability of the underlying in the next 85 days to finish in the money by 1 penny, okay? And that's a 45% probability of for the next 85 days, American Airlines rallies up to $32 and this strike finishes in the money by 1 penny. So it's trading 32.01 on the Friday, June 21st. Okay. So that's only a 45, that's less than a 50% probability. But in the next 85 days, 2 times the delta is the probability XYZ goes up and kisses me at 32. I'm 32. It comes up and trades $32. That is a 90% probability. Okay. And that would be almost a dollar something move. And if it was a dollar, let's say $1.50 move higher, to put this in the money, you can see $1.50 move higher. We would add in about another, it'd go up for the first dollar, it'd go up by 40 cents, right? So after the first dollar, it's trading 2.05, right? Because you add the 45 cents into this for the first dollar move. And we said another 50 cents. So it's going to be about half of all of this added together. So we're at 53. Divide that by 2 and we're at 26 cents. So we're going to end up being at around $2 and what is that? $2.30 when this is all said and done. And we come up and trade at that price, $2.30. is close to that 50% increase, right, that I talked about if the market comes up and kisses you. But that's what we're kind of looking for, the market to pick a strike where we just get kissed, right? And how you pick that strike between the 35 and the 45, you know, I don't care if you're using fibs or market profile and stuff like that, you know, for the 35 delta, maybe I think it's going to come up and at least test this area where it's kind of gone before, right? So that's why I'm picking that 36 strike rather than, you know, so I'm bullish as a meta, or actually that's way too far. So I'm 36 way high. So the 34s would probably be right in here. So, you know, that's even much lower. So I'm very content with the market rallying up through that. So picking your strike location between the 45 and the 35 delta is something you need to discern on how bullish you are. I'm going to be usually less for sure of myself and have the higher probabilities. So when I said we're beating the probabilities, if I can get out of this for a 50% increase because the market came up and kissed me, that's beating the probabilities, you guys, rather than waiting it out to the end of the day for this underlying to be in the money. And remember, we paid $1.61, so our break even is going to have to trade higher than this strike by $1.61 at expiration for us to just break even. So if we can get this market to rally up rather quickly and hit this, that delta in the market move will all get us to our target much quicker. If we wait that 85 days out, we need to get a much bigger move in order just to break even, right? So I'd rather get out of this trade early, get that move. Once that move happens, you pull the ripcord, you get out, right? That's how you stay ahead of it. I've been focusing on the delta being higher from the start, like a 75 minute. Oh, 75. Is that a, Sam, what are you saying there? Start like a 75 minute. I think you mean delta, right? Oh, minimum. A 75. So you like to buy the in the monies, right? And, you know, you can do that. I'm not going to scoff at it, you know, that you're going to get a better increase in premium as it goes up. I like to pick these a little bit further out of the money because I don't want to risk that much if I'm directionally wrong. One thing you will learn about me is I'm never confident about being directionally right. Okay. So, I think, you know, I've done charts. I know Fibonacci, the Ichimuchi, I'm kidding. The clouds and, you know, Bollinger Bands, Fibonacci, all of that stuff to come up with directional market moves in my 20 plus 5 years of trading. Okay. And I haven't found anything that's really, really consistently comes through. All right. So at the end of the day, I'm never confident that I'm picking the right move. All right. So I'm looking at trying to increase my probabilities of success and minimizing with a low probability strategy, minimizing how much I'm paying for it. Okay. I mean, you have a great probability of being in the money at expiration, a 73% probability, but also you're going to be losing a lot of theta in there as well. I like to go just outside of here. You know, these are the ones I don't want to risk a lot of money on, lower probability strategies. I'm usually doing these for like delta adjustments in my portfolio, or I'm just really bullish. Like this would be something I would be thinking, this looks like it's a time to buy it to me. And so that's why I kind of picked this. I went through and went through those. One thing to note, when you're buying calls, you do have to be aware of dividends. Now, it is a rule of thumb with dividends. It's supposed to happen. It doesn't always. But the idea with dividends in stocks, when this dividend comes out for 10 cents on AAL, the underlying is supposed to drop by that 10 cents on the ex-dividend date, okay? So the reason why is because anybody who buys that stock after that date doesn't get the dividend. So they price it in 10 cents less to, quote unquote, synthetically receive that dividend. It doesn't work out like that, you guys. Sometimes it'll drop by 30 cents. Sometimes it'll go up by $1. All right. It is a rule of thumb. It's supposed to happen. It doesn't always come through because free market price discovery comes in and moves the markets around. But that's the idea. You need to be aware of it, especially if it's a huge dividend. What if it's $1 dividend? That might be a time where you start having to think about it. 10 cents, I'm not too worried about it. All right. But keep in mind, you do need to be aware of dividends if it's coming up in the time that I plan on having this strategy on. Okay, I need to worry about that because the price of the underlying should drop by the dividend on that exit dividend date. But we don't necessarily have to worry about that too much here. But to keep it in mind, always double check that, all right, for your exit strategy when you're going through this. So we've pretty much gone through this, right? We've gotten our underlying. It fits the rule under 10 cents, under $100, 10 cents wide. We have low implied volatility under 50 percentile. That's a buy. As low as I can go is better, right? Another thing is with the options premium, the volatility being really low and the premiums being super cheap, that also means that I'm able to get closer to where at the money is, okay, for the same delta. And it's all a product of the expected move in this next several days. But remember, we're not necessarily concerned about what they're expecting. All I'm saying is they're expecting low volatility. It's at its historical lows for the last 52 weeks. That's a time to buy it, all right? I don't care what's going on. I just think that when it's this low, it's either going to stay right here, which, then that volatility isn't coming out, which is really what I don't want to happen. And the probabilities of it increasing are pretty darn good. So I'm willing to accept that even if this underlying doesn't move and the probabilities of volatility start rising and that happens, then we could stay sideways if volatility goes up. We've seen how our premiums would increase, right? So that will help us. It will help offset some of that theta decay and stuff like that when the market's not moving. Okay. All right. And then we got to figure out our profit. Our max profit is unlimited. There's no defined risk on this. It is defined risk in that the premium we paid for it is all we can lose. But there's no limit on if this XYZ AAL comes out and invents the electric airplane or something like that, they could go to infinity and beyond. That being said, it's not likely to happen. I've talked to you about the probabilities, right? We've looked at the probabilities on the XYZ and we know the likelihood of, American Airlines going even to just 50 in the next 85 days is basically a 1% probability. Actually, this is saying the chances are 0 and none left town. There is a possibility, but very minute, less than a 1%. All right. So not likely to have unlimited profit potential, really. And then our maximum loss is anytime we're paying for something, we are going to lose that net premium. That would be our net loss. And then at expiration is where our break even is determined here. And it is the long option plus that premium paid. Remember when we were talking about that option, I said, well, in the next 85 days, we have about a 90% probability of getting kissed on our strike. And that when that happens during the duration, we will probably see a 50% increase in our premium, right? Well, yes, but if we hold on to that all the way to the end of the day, we need to account for that premium paid because it was out of the money. It is out of the money options are only worth that theta and what can decay. So really they aren't worth anything unless they go into the money. But that's why we need to have the closer to expiration, that premium needs to be accounted for. So if we did the 32 strike and we are like a couple of days away from expiration, that means I need to be at $33.50 if I collected $1.50, right? I bought the 30, it's trading 30. I bought the 32 strike, the 32 calls for $1.50, right? My break even is $33.50. But if in the next couple of days, this market rallies up and hits my strike, I'm going to see that increase because I haven't had the theta decay eat away at me all month or the entire option cycle. Okay. All right. So I've gotten a little bit long with this one. If you guys want to throw a couple of examples out here of stocks that you are really bullish in, we'll see if it fits with the long call. Okay. So you can throw them out there. We'll go through the steps. Some of the first one to come up was Texas Instruments, TXN. So Texas Instrument, first thing we need to do, is it the right underlying? Texas Instrument, we're looking for the wrong option montage. So we're looking at XYZ, $100 stock, so 10 cents wide. That fits this rule right there anyway. And during open market operations, I believe it does. So Texas Instruments fits that rule. Now I go out and I say, all right, well, is it the right environment? My rule here is below 50 IV percent. We can be buying this. It's a 20. That's pretty low. Just go over here and check the charts. Yes, it has a pretty low implied volatility percent. You know, we got this crossover. Let's say that's when the 200-day and the 50-day moves over. That becomes a bullish move. We've got a higher market, nice doji, whatever you want to say. We're bullish in Texas Instrument. So we picked the right underlying. We've got the right environment. The duration, we know we want to go outside of around that 60, 70 days, right? The expiration, this is what we'd be looking at. Picking the right strikes. We're going to be probably doing the 35 delta here. And on this one, I'd probably be doing about a 5 lot, all right? Because of a $200,000 account. I don't want to risk more than, you know, $1,000 or so. So I'd probably be doing about a 5 lot here. Okay. So go through those steps with yourself. Where's my exit strategy? Write all this stuff down. Plan your trade or plan your trade and trade your plan. All right. Or you plan to fail is really what it comes down to. So we paid $1.60 for this. Let's say if we pay $1.60 for it, then when this underlying increases by 50%, which is another $1.30, right? Half of 260 is $1.30 or $1.35, you could say. I'm just going to go with the $1.30 for math purposes. And that gives us $4, right? $1.30 added into $1.70 gives us $4. So I would write down on a piece of paper in my spiral notebook over here, all right, XYZ or Texas Instrument, I'm bullish on it. I found it had low implied volatility around 20%. Write that down. Its duration was 85 days to expiration. I picked the 35 delta strike paying $2.69. I'm getting out at $4. All of that stuff is written down, right? According to those rules that we went, or these essentials to success. I just went right through these, wrote them all down right next to it. Exit strategy, no dividends. All right. And then that way, when XYZ comes up and hits my strike, I can check. I said I was getting out at $4. Am I there? And do I want to get out? No, right? So if it's at $4, yes. If you said once it comes up and kisses me on my strike, I'm out. That's fine too, right? I have a buddy that has a time stamp on his stuff. You know, he would see a chart set up like this and he was like, I'm bullish. I'm giving this trade 5 days. And then he would write that down. This is the date. 5 days, I'm out if I'm not seeing it move in my direction. Okay. Why not a GTC? Banu, you are more than welcome to use a GTC on this. A lot of times on the premium buyings, I will put in a GTC. I don't always because, you know, I'm the guy that's here, you know, at 5 o'clock in the morning till after the close looking at markets. So my stop or my GTC is my trigger finger, but I have no problem with you putting in a GTC on these trades once you've done them. But I would still write them down only because you can you have the data to go back. You can go back and check yourself, all right? It's not just looking at the P&L. You'll be able to see more detail as to what was working and what was not working, all right? And then somebody else was saying Microsoft. I saw it was Sam or Bob said Microsoft. So Microsoft, we go through, we're bullish in Microsoft, right? We've already discerned that. Is Microsoft tradable with options? So we say it's $116 stock, three ticks to the left, 11, 12 cents wide. We go over here during open market operations, not after the close, and see that rule fits. Or actually, we would do it closest to expiration, and we would see that rule fits. So then we know we can go out here and trade this product. And the reason why is because if there's a lot of eyeballs in here making tight markets, these guys are thinking about moving out into those other expirations or creating a hedge and stuff like that. So they are watching these out here. There's a lot of volume and open interest in tight. They have interest out here, and we'll be keeping an eye on it. So I would probably be picking this 42 delta, the 120 strikes for this one. It's closest to the 45. I don't have a 35. I don't want to go too much further out because I only have a 50% chance of a 50-50 chance of getting hit out here. I'd rather take the 85% chance of getting hit here, right? And in that case, $100,000 underlying or $100,000 account, I'd probably risk 1,000 to 1,500. So I'm going to be doing less than a 5 lot, right? Does that make sense for you? Bob, I'll do your other one real quick too. IWM. I may have a, and one thing about all of these things, I may have positions in some of these. It's not to get you guys limbing off the cliff with me. It's just that it fits everything that we're talking about. All right, so I'm bullish IWM. I come into the option strategy. All right, well, can we trade IWM? Move it 3 ticks left, 15 cents wide, and the option's closest to expiration. And we see that fits that rule easily. You know, ETFs, you don't usually have to worry too much about that rule because they fit it, generally speaking. 45 days to expiration. I'd probably pick this one a little bit further out. You can go all the way out to this strike here. But, you know, and the determining factor is how bullish am I? Well, do I think it's going to trade up to, what were my strike prices I was looking at, 140 or 158? So do I think it's going up to 158? Do I have a reason for that? Well, I could say that maybe it's going to peel through that, or I'm more comfortable picking this Fibonacci and saying, you know, like the 155 or something like that, which fits this one. Okay. So that's the one I would go to just because I think it's going to go up and maybe test this Fibonacci. Okay. So that's why I'm picking that one. I don't want to pick even though I think it's going to go, maybe I think it's going to go up and test the 200-day moving average. I'm a little bit safer for this one. Right? Do you pick the at the money strike for checking the 10-cent wide bid ask? I check. Great question, D. I appreciate that. I check the just out of the money or at the monies. I don't go into the monies necessarily for them. But if they are very close to it, it will fit that rule if they've just gone slightly in the money. But yeah, I like to pick the ones close to the expiration, just slightly out of the money. Okay. They have a tendency to have more volume and open interest than those. So you get a good idea as to when my underlying has gone to my strike. Kind of gives you that idea as to the kind of amount of volume that should be trading at that price when it gets there. Okay. It's not perfect, but it is a pretty good assumption. And that's pretty much it, you guys. It's relatively simple. When, you know, I kind of broke it down for you, you knew what we were getting into with the long call, and, you know, there's no real way to sugarcoat that. I had to let that cat out of the bag for you so you could follow along. But what I want to know is, did that help you guys? Like going through, I've got this bullish assumption, but I really don't know what kind of strategy I want to put around it. Well, we go through these steps and we kind of peel back the onion, and all of a sudden we realize, oh, the only thing that would really work for this bullish assumption that I'm really bullish on is this strategy. Okay. So, That's what we're looking for. We're really bullish. As a matter of fact, with this one, we wouldn't even be thinking, you know, trying to cover my risk here by picking the one that's close here just in case it doesn't work out and it kind of rolls over. But if I'm super bullish on it, then, and I think it's going to continue to go, then that's what we're looking for. Okay. All right. You guys, I want to thank you guys all for participating in this webinar. One thing we've got here for you is this deal right here. It is how to trade options like the Wolfman. You guys can click on the link over here in the chat window. We've been going back and forth in the questions box. The chat window has a hot link to this. So I'm putting it in there right now. So you can click on that. You get all of these. You get more ways to judge your odds with Delta. There's a lot of different things I said that Delta tells you will help you out with that. A little bit more detail on Gamma as well. How to trade that market profile. That's the thing, you guys, I use the most. You know, I know people use Fibonacci and all kinds of different metrics to put on the charts to figure out where the market is going to go. I like the market profile. I explain what my reasons for that are in there. And protecting your portfolio against rising interest rates, you guys, it is a must. So many people do not look over at that bond portfolio, and it's 50% of your portfolio, you guys. You're neglecting 50% of your portfolio in this type of environment we're in, not taking advantage of this specific webinar. And for $36, you guys, it's worth it in and of itself. So if you guys want to learn how to trade options so that you're confident going into it, you know how to stay mechanical, you know how to increase your probabilities even further, then you guys should take advantage of these webinars. Because just like in this webinar, I go through those little details that you aren't going to find online. Yes, I know you guys can go online and figure out how to do a long call. All right. I'm not going to lie. Yes, it's everywhere. But how many of those people are telling you where volatility needs to be for that underlying, what the strike location needs to be to increase your probabilities of success, how to get out of this, all right? So take advantage of that for 36 bucks. Sam's saying, yes, I learned some stuff, but would like to review again. Is this taped? Yes, this is taped, and it is going to be sent out to you guys. It's going to take a little time for me to compress it and convert it and upload it and all that stuff, but you should be getting this relatively soon. So watch it again so it's fresh. If you guys wait a month down the road, you're going to be like learning this all over again, all right? So when you guys are using the right tools for the right situation, you guys are going to be more productive, all right? You're going to be able to put on more strategies, which creates more opportunities, all right? When we have more opportunities with high probabilities, we are going to be super confident and able to continue this snowball. It's going to start out small. You guys are going to be putting on a couple of them, and then all of a sudden it's going to be snowballing. You're going to be realizing the more I have on, yeah, I'm losing on a couple of them, but I'm winning on a lot of these, all right? And, you know, one thing about these daily market commentaries I do every morning, you guys, I talk about every single trade I do. Win, lose, or draw. It doesn't matter. If I'm losing on it, I'm talking about that trade in the daily market commentaries. I'm not going to sugarcoat it. I am going to show you how I'm mechanical and how I'm staying with this trade, or if I'm just dumping it. So please watch those. They're great. If you have any questions, you can reach out to us at 310-598-6677 or email us at trading@protraderstrategies.com. This link is right here, how to trade options like the Wolfman. Very easy to see, but I suggest everybody click on that link over there in the chat window. That's the easiest way to get it. If you're watching on tape delay, you're going to have to pause. This is not a hot link. You'll have to type that into your URL. All right. So here's the number. Here's the email. Please reach out to us. Follow me on Twitter at Wolfman's blog and check out those daily market commentaries. All right. You can follow along to see if me, practicing what I preach. All right. Planning my trade, and then trading the plan. All right. Take care, you guys. Have a great one. I appreciate everybody sticking around a little bit longer than normal. Take care, guys. Thanks. Bought the course upon signing up. Thank you, Sam. Appreciate it. Enjoyed. Great course. Thank you. Thank you, Bob. Appreciate it. It's a great presentation. Appreciate that, you guys. All the kind words. Everybody's blowing it up now. I don't want to beat a dead horse with everybody throwing me praise, but I do appreciate it. Thank you. Take care, guys.